What's going, guys? Hope you're having an absolutely fantastic day. So the other day, I was watching a 1 hour long interview with Howard Marks, and it dawned upon me, right? Why not cut it down to smaller snippets, right? Because I'm already doing it, right? I'm already watching all these 1 hour long interviews or podcasts or whatever it is, right? And I understand that a lot of people don't have 1 hour just to sit through all these things, and some people might find it boring or like not understandable or too compact, right? So it came upon me this idea to basically break it down, look at the most important points, write it down on a notepad, and then make videos on the most important points of the video, right? Because even though these videos provide a lot of value, there are still some moments where it's not so applicable or it's about macroeconomics, and some people might want to skip that, right? So if we take a look at something like this, right? It has 33,000 views in 2 weeks, right? Howard Marks talking about financial markets distress, right? And I can tell you, I learned so much from this video, right? But when you take a look at something like this, warning massive sign from Buffett, this stock market crash soon. Look at the views, right? 63,000, 9.2 thousand. And I'm not saying anything bad about it, right? Because I also watch these videos, right? But I feel like this compared to this is definitely, this wins, right? By a mile and stretch, right? For when it comes to education value. Of course, this definitely wins when it comes to entertainment value, right? Because look at this, 4 minutes. How much can you learn in 4 minutes? So what are my plans with all these videos? So basically, I'm going to highlight the most important points, in my opinion, in these videos, and you can expect more of these videos from me, right? Because you can see just 1 hour long interview. I can make 5 videos from this, right? And also, I have a Stanley Druckenmiller one, which I've already watched, and these are only in the past 2 days or something like that, right? So this will probably act as like a huge backlog, so you can expect more videos from me, right? And especially more educational videos, right? So without further ado, let's watch a video, and I might pause to make some points, right? So sorry if that annoys you, right?
All right, so let's get down to business here. The sea change memo that you put together, I thought
Let me just speed it up a bit.
was provocative, and I won't steal your thunder, but it threw out lessons from the past about investors who get enamored with a particular strategy, type of investing, FANG, FOMO, memes, all those types of things. And if we really are pivoting or in a regime change here, I think it would be helpful to think about what that could mean and what does the next regime look like.
Sure. Before I answer your question directly, Bob, I want to respond to something you said at the very beginning, because you said this is a particularly uncertain time. And in my experience, there are two kinds of times. There's the times when you know what's going to happen in the coming 10 years, and the times when it's uncertain. And the main difference is that the first time, you're wrong. If you think you know what's going to happen, you're wrong. And that's kind of what my experience showed. And,
Okay, so this is basically just Howard Marks talking about people who make stock market forecasts, and they're very sure they're right? Because most of the time, people are wrong, right? And you don't know what the future holds because there are a lot of unknowns as well, right?
I wrote a memo in October called The Illusion of Knowledge. And I quoted the historian Daniel Boorstin, who said that the enemy of knowledge is not ignorance, it's the illusion of knowledge. When people believe they know and present themselves as knowing, it interferes with exploration. And maybe the other way of saying it is what Mark Twain said. He said, it ain't what you don't know that gets you into trouble, it's what you know for certain that just ain't true. And so I would say right now, Bob, we don't know anything for certain. There have been other times when we did know for certain, and we were wrong most of the time. But anyway.
But it does seem that we've been through 40 years of declining interest rates, and at least 15 since the financial crisis, and that's ending. And there is this great unknown now.
Sure. And I say in the memo that in 1980, I had a loan outstanding from the bank in Chicago, personal loan, at 3/4 over what was called prime at the time. And I would get a slip, crudely generated slip from the bank each time the rate changed. And I have framed in my office the one that says the rate on your loan is now 22 1/4. December 19th of 1980. 40 years later, I was able to borrow at 2 1/4, fixed for 15 years. So this was a massive change. And whereas I assert that I don't know much about the future, the one thing I'm sure of is that rates are not going to go down by another 2,000 basis points. right? And
Okay, what he means by that is basically rates are not going to go down another 20% as they have during his time, right? Because during his time when he's talking about 1980s when he bought his house, basically what happened was the prime rate was at I think 20 something percent. So it would be like 20 something percent plus 3%, right? For his mortgage. And what happened is it went down from 20 something percent to 2% or 3% or whatever he said just now, right?
so if this massive period of decline is over, then the question is, what does that imply for all the things we do? And as Bob says, it was the 40-year decline from Fed funds rate of 20 to 0, and then more recently, again, the Fed set the Fed funds rate at 0 at the beginning of 2009 to pull us out of the global financial crisis. Left it there for 7 years for some reason that I find inexplicable, and kept rates basically low from the beginning of 2009 through the end of 21. And those 13 years are the subject of that I explore most in the memo. And of course, this was facilitated by the fact that despite the high level of stimulus from the 0 rates and quantitative easing and the resulting decline of unemployment, we still didn't have inflation in that period, which permitted the Fed to maintain that regime of low interest rates.
Okay, so macroeconomics, so let me just break it down a bit, right? What he's talking about is we had this gigantic Goldilocks period, which for some reason worked out, right? You have 13 years of Fed policy being at 0 rates, and at the same time, there was no inflation, right? Because you can see that the Fed can cut interest rates to 0 and leave it there, right? As they did from 2008 until around 2021, 2022, right? So what happened this time is they cut rates, but at the same time, there was huge stimulus from the government, right? So there was inflation this time, right? So if there wasn't inflation, rates would probably have stayed at 0, as Jerome said, until 2025 or even beyond, right? Because maybe at that time there's some deflation because of AI or whatever it is, right? But in this case, once there is inflation, then the dynamic is changed, right? So for those people who are wondering, the Fed did it from 2008 to 2021 or 2019. Why can't they do it again, right? And that is the real answer, right? Because of inflation.
And that's, in my opinion, what's over. Now, I'm not saying that rates having come down are going to go back up. I merely say they'll probably kind of skate along here. Anybody who joined the industry in the last 15 years probably thinks we're in a high interest rate environment today, right. But we're not. We're in a normal interest rate environment, I would say.
Right. Very important, very important. Everyone that has been joining since 2008, and this is basically the whole generation of young investors, we've been investing in 0 rates, right? And now that we have like 5% rates, we think it's super high, right? But actually, if you look at the historical returns of the S&P, it's about 8% to 10%, right? So if you look at that, then you realize that 8%, 5% actually is a risk-free rate, and 3% is a equity risk premium, right? Which I don't really use to calculate, but that is what people have been saying in the past, right?
Largely normal. And I think so one of the tenets of Oaktree's investment philosophy is that we don't predicate our investments on macro forecasts. We don't believe in macro forecasts, especially our own. And so we try, but interestingly, you have to have some thought about the macro environment in order to make a prediction, and you have to predict earnings, cash flows, whatever it might be, in order to be able to buy an asset.
Okay, and this is a very important point, right? A lot of people will go, I don't do macro and stuff like that, right? So what he's saying here is, I think, words that I couldn't have articulated any way better, and I couldn't explain this in the past, right? But basically, you have to have a macro forecast, right? But you don't have to use macroeconomics to make your decisions, right? Because if you're buying a company, right, let's say auto company, right, definitely you have to have a macro forecast, right? Because if you think interest rates are going to continue to rise for the next 2 years or something, let's say you're in 2021, you're looking at Tesla and you think that interest rates are going to rise, right? Then clearly that's telling you that, it's a bad time to get into autos, right? Because people need to finance those autos to basically get the cars, right? But you don't have to say like, oh, because macro is bad, I'm not going to look at anything, right? Basically, because even in a bad macro forecast, there are pockets that do well, right? So if you're enjoying the video so far, do help me smash up the like button, hit subscribe, and also hit the bell button and press on all, right? So this will really help out the channel. And also watch till the end, right? Because obviously you don't want to miss any important information.
So, but the answer is that we make neutral assumptions. And today, I think the neutral assumption is that rates stay where they are.
So what do you do with that? Do valuations revert to some historic mean? What happens after 15 years of your 2% loan?
Yeah. Well, I mean, for every basic interest rate, there's a range of appropriate discount rates or whatever cap rates, whatever you want to call it, for every asset. And the cap rate that is a friend of mine bought retail on Fifth Avenue 10 years ago at 2.5 cap rate. I dare say that's not. I dare say that's not appropriate today. Right. What is it for that property now? 7 or 8? Yeah. Okay.
Okay, so now what he's saying that is one of his friends bought at a cap rate of 2.5%. That means basically a 2.5% return. You can think of it that way. So now the cap rates are 8%. What happened to his friend is basically the value of the property, right? If the rentals didn't grow, the value of the property is now 33% of what his friend paid.
But anyway,
around that.
The other thing is one of the most important lessons is never confuse brains with a bull market. And I was talking to Bruce Karsh, my partner, 2 days ago. We had a call with a client. We were talking about this thesis. And when I got off, I called Bruce and I said, what occurred to me is just think of somebody who had the idea to buy an asset, whether it was a property or a building or a company, within the last 15 years, and went to the bank and bought it with borrowed money just before having interest rates decline steadily. You'd have to be seriously deficient person to lose money, because the declining interest rates make every asset more valuable, discounted present value of future cash flows. When the discount rate declines, the present value increases. And then you borrowed money, and every time you had to renew your loan, it was at a lower rate. How could you not make money on that basis? This was a great period.
What he's talking about here is basically borrowing money and making the spread, right? Because basically what he's saying is your returns are 6%. Let's say you go out, you find a property deal that's 6%, right? Whatever it is. Let's say it's 1 million, you make 60,000 in rental a year. So your borrowing cost is 50,000. So you make that 10,000 a year, right? And you can imagine that these people have scaled this up to like hundreds of millions or billions, right? So what happens is when the renewal from the bank loan comes up, right, it goes from 5% to 4%. And what that essentially does, right, if your selling price goes from 6%, let's say your cap rates go from 6% to 5%, right, then basically you just earn like a 17 point something percent increase in your asset value, right? So imagine that keeps happening and it goes from like 5% to 1.5% to 2%, right? So in that case, even if your rental didn't move, right, your cap rates going down would mean that your property essentially went from 100,000 to maybe 300,000-400,000 just by the nature of interest rates moving down.
People who owned assets, great period for people who borrowed money, and a double bonanza for people who bought assets with borrowed money. But if that's changing, if rates are done declining, then you have to know that.
So, and I think I want to save the real estate questions for a little bit later. But so some of us have done the math on, so rates stay the same, the $4.5 trillion of mortgage capital out there is going to refinance at the new rates. And there's projections that to maintain current loan to values with these higher rates would require an additional 500 to 600 billion of additional equity capital. That's just in real estate. I want to focus on the broad economy and markets.
Right.
If you believe that that where we are today is not only the old normal, it's the new normal, and it's going to maybe be higher for longer, maybe forever. Have you or Oaktree thought through, okay, so like the real estate example, if that flows through the economy, and I'm particularly concerned about away from real estate, I think more money's going into private equity, financed probably with leverage loans, 3 or 4 year maturities. Mm-hmm. We don't have any way of tracking that. In real estate, we can track. We know what's going on there. If those loans are upside down, what is the impact on the economy, on the market, on the stock market, on the banking system?
Sure. Well, I put out a memo last Monday about the banking system, called Lessons from Silicon Valley Bank. And I don't think that the bank is threatened. The banking system is threatened. I don't think it's comparable to '08. In '08, we saw Merrill, Bear Stearns, Wachovia Bank, Washington Mutual, and ultimately Lehman either disappear or require rescues or be acquired. I don't think this is as thoroughly taken up within the financial system as were the subprime mortgages and the relating RMBS. And of course, remember that the banks at the time were making so much money from packaging mortgages into RMBS that they would buy the bottom tranche in order to facilitate the process.
Right.
So, and I don't think that the banks own the bottom now. I think they own the top. I don't think
I'm not concerned about the banking system either,
okay.
but
All right. Well,
the impact on the economy.
Well, people will, people are going to lose money because when Bob talks about it requiring a $500 billion of equity capital to re-equitize the real estate.
I think that's something that nobody wants to say out loud, right? A lot of people are going to lose money, right? Because of all these commercial real estate or whatever loans, like they are levered long and now they're upside down, right? And what levered long basically means is you take on leverage to go long, right? Which is what happened to FTX and all these bankrupt companies, right? Basically, you have borrowed money on your balance sheet. So when your equity shrinks, right, it destroys all the equity and then it takes you under, right? Because you have borrowings, right? If you don't have any borrowings, your equity can never go negative, right? Unless it's banking or whatever it is, right? But let's say you're running a normal company, right? If you have no liabilities, right, you can never go bankrupt because your equity may be able to go down, may be able to go to zero, but you can't go negative, right? And if you can't go negative, no one can force you into bankruptcy.
Industry, and let's say a similar amount for the private equity industry. What he omits to say is that the old equity might be gone. Somebody's going to eat those losses.
Right.
And Oaktree's greatest business is investing in distressed debt, and we started that in '88, and it's been a great business for us. But it's mostly predicated on the fact that even good assets can get overlevered, and if they're overlevered, the probability of getting through a rough patch declines.
Okay. Remember that even great assets can get overlevered, and if they're overlevered, they will fail to get through a rough patch. That's a very important line.
Ability to get through a rough patch is all else equal is proportionate to the amount of equity on your balance sheet. And of course, when things are going well, people disregard that and they go for the highest leverage they can get because, as they say in Las Vegas, the more you bet, the more you win when you win. But so what we do is we buy the debt of those over-leveraged companies when they suffer difficulty, and we do it with properties too, because not everybody's going to put in their share of the $500 billion, and not everybody has it to put in. And people let things go. So there'll be losses, and throughout the economy, certainly throughout the investment world, and that will have a deleterious effect on everything, and it'll seem you think it's uncertain now. When that happens, everybody will be certain that it's going down the drain. Right. But of course it never does. And remember.
And that's when you want to be looking to buy, right? When everyone is sure that the system is going to collapse. Oh my God, everything's going to zero, right? That's the moment to buy, right?
I think the global financial crisis was much worse for the financial system than this is, and we got through that.
Well, what do you think this is?
Pardon me?
What do you think this is? Plain vanilla recession, typical cycle? How does Oaktree or you think about it?
I think it's going to be a moderate recession. And by the way, that's one of the many forecasts I don't believe. But nobody thinks it's going to be an economic cataclysm. Among other things, if the normal description of a cycle is boom bust, we didn't have a boom in the real economy. Right. We had the longest economic recovery in history of exceeding 10 years during this period I'm talking about, but it was also the slowest. So we didn't have a boom. Where you had excesses, perhaps were in leverage finance, And so equity investors will lose money, and junior debt holders will lose money. I think that's what's going to happen.
So
I think that's slightly wrong. Maybe the boom period was during the Fed easy monetary policy and during the fiscal policy from the government, right? And I think what he's saying is definitely correct. Nobody expects it to be a cataclysmic recession, right? Which begs the question, right? If nobody expects that, then is it potentially going to be that, right? So nobody knows, right? And what he thinks is there is going to be a moderate recession, right? So yeah, this is probably the ending for this first part of the video. So I think there will be 3 or 4 more parts where I'll be covering this video. So if you did enjoy a video like this, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.